Hello friends, how are you all? I hope you all are doing well. I am good too. So students, in this video, we will start the revision of Ind AS 33 of earning per share. So before this, I gave you the revision of Ind AS 41. That was completed in one lecture. This is lengthy and important, so it will take some time, but we will summarize things. First, we have part number 1. Part number 1 means lecture 1. First of all, students, I told you that what is the objective of the Ind AS 33? Before starting the EPS, I had told you about the objective of EPS. We had discussed two main objectives. Let's do this quickly. We had discussed two main objectives. First objective, the industry you are trading in, there will be many companies within that industry. So if I disclose earnings per share of any company, you can compare that company to another company of the same trade to get an idea of how this company's performance stands to the other company's performance. And I had even given example that if we talk about the cement industry, then Ultratech's comparison can be done with Birla. And if we talk about Airtel, then its comparison can be done with Jio. Furthermore, just this earning per share compares performance very rapidly. What is earning per share? It is summary of your profit and loss. That how much money did you make for one share? And the second objective I had told that in the same trade, not only the comparison between different companies happen, but the entity compares itself too. Financial statements are printed for 2 years, previous year and current. So upon comparing the EPS from last year with this year's EPS will reveal how the company performed last year and how the company is performing this year. Do you get it? So we can analyze this performance in two ways, within the industry and within the entity in two ways. And then I had told you one thing, that why are we even doing these comparison? It is for one objective only, that investment decision should be supported. Be transparent with your investors so that they can decide whether they want to invest in your company or not. Whether a new investor invests in your company or not. Those who have invested in it are either making money or leaving. As you know, you have to decide whether to hold on or to quit. Okay, whether to invest or not, all of these things are based on EPS. You must have seen, whenever a company's financial reports come out quarterly or annually, its direct impact is on its market price. So we had discussed these two things. We had discussed these 2 points. Then we came to unit 2. And we had talked about types of EPS and other issues. I will put it on screen. Types of EPS. There are two types of EPS, basic and diluted. You have studied this in CA Inter and in AS 20 as well. There are only two EPS, basic and diluted. I had told you additional 3 to 4 points in other issues. Point number 1. Earnings per share does not mean that the company will make a profit and only then it will show EPS. The company's profit level might be 0, it might be negative, or suppose its profit level is positive. Whether the company is in loss, profit or at 0, you have to report earnings per share. The name suggests earnings per share. Some people has this misconception that it is not necessary to show loss per share. Earning will only be shown when present. Understand the objective of our EPS, which is to make comparisons. How can comparison be possible if you don't report EPS? So earning means may be 0, negative or positive. Reporting EPS is mandatory. Profit level does not matter. Point 2. Basic and diluted, both of these EPS are equally prominent. And there is no permission to select any entity. If any entity or client tells you to calculate diluted information, as we don't have basic, or calculate diluted as basic is not there, both EPS are equally prominent and will be included in disclosure. Selection of EPS is not allowed. Both are mandatory, not optional. Third thing, the disclosure of earnings per share. It will be separate for the standalone financial statements and separate for consolidated financial statements. No holding company can say that they have disclosed the group's EPS in the CFS. So we don't need a standalone, but that's wrong. Now you will say that from where did this point come from? This point came from IFRS. What does IFRS say? If you have disclosed EPS in CFS, then there is no need to show the standalone EPS of holding and subsidiary. But it has been clearly stated in India that holding and subsidiary standalone will be shown, and along with that CFS will also be shown. Let's move ahead. I told you these 3 points. This was presentation of EPS will be made even if the company has negative earnings or nil earnings, because main objective is comparison. Okay, then I had told you both EPS is equally prominent. Then third point, calculation and presentation will be made for standalone and consolidated separately. First of all, I told you the objective, the types of EPS and other issues. Then I brought you to the main part, explanation on basic EPS. The basic EPS formula is the same as what you studied in AS20. The formula has no changes. The formula is earnings available for equity shareholders divided by the weighted average number of shares. EAE divided by weighted average number of share. And then what did we start first? EAE. We started first concept of EAE. What does EAE mean? Go to profit and loss, check all incomes, subtract all the expenses from that, P&L is made. You need to use information of P&L only. Income minus expenses minus tax expenses. As soon as you minus the tax expense, you will get the profit after tax. What will you get? Profit after tax. And then you have to learn adjustment of preferential capital in it. And I explained the adjustment of the preference share capital with ample amount of time. First, incomes minus expenses minus tax expenses minus issues relating to preference share capital. You will get earnings available for equity shareholders. Look, income, expenses, tax expenses. Adjustments relating to preference share capital. And one thing more which I think every student already knows is, in Schedule 3, P&L is divided in two headings. One is normal profit and second is other comprehensive income, OCI. So, it is clearly written in the end AS33 that OCI part won't be included in the EPS. We don't calculate EPS based on total comprehensive income. Instead, we calculate EPS based on normal profit. Clear? You all know OCI, revaluation reserve, foreign currency translation reserve very well. The PVDBO or plan assets remeasurement. All these are non-cash items. All are non-cash items. Valuation of financial instruments is non-cash. OCI is not included in EPS. OCI part is not considerable for EPS. Only the upper part, income, expenses, tax expenses. And adjustment of preference share capital on that basis calculate EAE and report EPS. OCI will not be considered. We have discussed this. I am not telling anything new, I am just revising it. Then I started the explanation of preference share capital. We had discussed it very well and we spent a lot of time on it. In the beginning, the first adjustment of preference share capital that I had told you, that was cumulative, non-cumulative, cumulative, non-cumulative dividend. Cumulative, non-cumulative dividends, and now we will divert from AS20. The AS20 concept is over and the IND AS33 begins. We did not study these points in AS20 because the approach of AS and IND AS is different. We don't know what we had studied in AS. It is okay. Ignore the reference I am giving. It's not necessary to listen everything. See this preference share capital. The IND AS33 explained two types of preference share capital. One is redeemable and one is irredeemable. If your preference share capital is of redeemable nature, so let's say your preference share capital is redeemable in nature, which is anyways redeemable. As section 55 says that the preferential capital is redeemable in India, its maximum period is 20 years as we study in Inter. You must have studied in AS 109 in financial instrument that redeemable preference share capital is assumed financial liability. And when we consider preference share capital as financial liability, then we show it in non-current liabilities, not in shareholder funds. Only equity share capital comes in shareholder funds, or the other equity comes. Preference share capital comes under financial liability, and we don't calculate dividends on that. We calculate interest on the financial liability. If we talk about interest, it comes under P&L, so it must have been included in expenses. The interest on all the redeemable preference shares capital must have been included under the expenses in P&L in the finance cost. So no adjustments to be done. So you wrote income minus expenses minus tax expenses. So the interest would have been included in the expenses. We consider redeemable preference share capital as financial liability and find interest based on IRR or market rate and show in P&L. There is no concept of dividend. If you have issued preference share capital on market terms, then IRR. If on off market terms, then market rate. You know everything. And the interest calculated on this is written under P&L. So for that, no special adjustment needed. For EAE, income, expense, tax expenses are needed. But if your preference share capital is irredeemable, what are they? They are irredeemable, which is not allowed in India. Section 55 deems the irredeemable preference shares illegal in India. You just cannot do that. Clear? And yet it is discussed about in the Ind AS 33. Why is that? Because the Ind AS which we have is the copied version of IFRS, the statements made by the British. We are not doing anything, just studying the statements we got from Britishers in India. You transferred the worries on CS or on their children to take care of this. Ind AS has points, so I explained it as you won't get it practically. So your irredeemable preference share capital, that's an equity instrument because when you don't have to pay. Then there is no financial liability. Its definition given in 109 states there should be some cash outflow. Accurate definition is that there should be some contractual obligation to deliver cash outflow. There should be contractual obligation to deliver cash outflow, but it's not. When we don't have to return money, then irremovable abrupt equity instrument. Let's talk about dividend. When we talk about dividend on this, because this is an equity instrument, then two things will come: cumulative and non-cumulative. If your irredeemable preference share capital is of cumulative nature, you have to listen to this carefully as this is important. And you have to take dividend every year on it. Clear? This means you wrote income subtracted expense and then again subtracted tax expense. Hence, this will be PAT now minus cumulative preference dividend. Clear? For the current year, cumulative feature is that if you don't give dividend for 1 year, then next year you have to give for 2 years. Same goes for second and third year, so it goes on. If company was in loss and company could not pay dividends, then that right would be carried forward. We cannot leave it. So in AS 33 says that don't accumulate the cumulative dividend because we have to compare EPS. If you don't take dividend for 1 year, next year you have to give for 2 years. Because last year there was no profit, how will we compare? It will be a mismatch. You should ignore the profit level. While calculating EPS, you should take cumulative preference dividend on per annum basis. Don't see if profit is positive, negative or nil. Why? Cumulative dividend for 1 year, then 1 year and it carries on. You take it on accrual basis. Because if you don't take it on accrual basis and use payment basis, the first year will be loss with no dividend. Second year will be the same. You have to give for all 3 years in third year. Last year's dividend was 0, now it's for 3 years. How to compare EPS? Comparison is based on consistent policies. Then you will take cumulative preference dividend on annual basis. Clear? You will take on accrual basis without seeing profit level. And if I am making financial statements then of 21-22, I won't see profit level for 21 and 22. I will minus preference dividend for current year. But students, pay attention here. If your irredeemable preference share capital is non-cumulative, then irredeemable here and irredeemable here again, then this will be over. Redeemable is financial liability. There would be an interest premium on it. I am talking about a foreign concept. If irredeemable preference share capital has non-cumulative nature, so if your preference share capital is irredeemable and it's non-cumulative also, then take its dividend on cash basis rather than taking on accrual basis. Now how on a cash basis? You know very well that when AGM will be called in the current year, that is for previous year. The dividend that will be declared and paid at the AGM for current year will be for the previous year. Whatever dividend you pay in the current year, just deduct that much. In case of non-cumulative, you have to take preference dividend in cash basis. If I am preparing financial statements for 21-22 and if I am paying any dividend this year, I will just subtract it. Since this dividend is from last year, so it would not have been provided last year because you know that the current year's dividend can't be proposed in current year. It finalizes in AGM and then payment is made in 30 days. Therefore, the dividend for non-cumulative preference share capital should be taken on cash basis. If you have paid anything in the current year, you should minus it. And I know that the payment I am making in the current year is the payment for previous year and it doesn't matter what proposal we made last year. Now students, the non-cumulative dividend will keep running on cash basis. If you pay, then deduct it and vice versa. Understood? And the cumulative dividend will keep running on accrual basis. I told you to note all these things. Let me check this. See this redeemable preference capital. There will be no discussion on it regarding dividends because it is considered as a financial liability. We would have calculated the finance cost on it at IRR or market rate and such finance cost would have been included in expenses. Irredeemable. As per section 55 of company, this kind of PSC can't be issued in India, but discussions have been made in Ind AS 33. Thus we will have to learn this. We have to refer the notes and here is the explanation. So these are notes. All the things which I am telling you are written in the notes during class. Okay students? If PSC is cumulative in nature and if it's non-cumulative in nature. Cumulative on accrual basis, whether it is declared or not. But I need to take this on a cash basis only. Paid. Okay, paid. This is accrual and this is paid. Paid in current year accrual basis. Then I explained some points. In the case of cumulative irredeemable PSC, dividend on PSC will be deducted out of net profits on accrual basis irrespective of income. Do not see if profit is positive or negative, take it on accrual basis, don't let it gather. In case of non-cumulative PSC preference dividend, it will be deducted if it's declared and paid in current year. It means that it will be considered on cash basis. All these notes are written on the screen. You can pause and read it anytime. Clear students? We have discussed all these things in class. Then I gave you two examples where you had to find mistake. Look at this. It's all study material. I am just here to teach you. These are all study material. The net profit for 2021 is given. We have to tell the mistake. We have to find the mistake. Preference dividend. Non-cumulative for the year 2021 is given. Now tell me, net profit is 2021. How did it come on accrual basis? You already know non-cumulative, it will be declared and paid next year in AGM. So students, this should have been 1920. Dividend from last year will be paid this year as it has to be taken on cash basis. It's on accrual basis. The cumulative one is correct as it's on accrual basis. When you see error, the cumulative dividend is correct because it is taken on accrual basis. But non-cumulative is incorrect because it cannot be taken on accrual basis. It should be 1920. There is another example in which you have to find mistake. The net profit is given for 2021, then dividend will be less, right? Cumulative, this is wrong. Cumulative should be 2021 on accrual basis. Non-cumulative is correct at 1920. Last year's will go this year as it is on cash basis. Cumulative is wrong. Treatment of cumulative dividend is wrong as it would be deducted on accrual basis. It should have been on accrual basis. These two examples that I have given you are based on the concept we discussed earlier. All the concepts are there in notes. So students, I want to tell you that I am a different teacher. I don't teach very fast. I always go in great detail. Shortcut is the trend now. No problem. All these things are very well taught to you by me. Then I told you assumptions on PSC. First assumption. If in your question it's not given that preference share capital is redeemable or irredeemable, then the practical concept should be assumed redeemable. I hope you are following me here. Because irredeemable is not available in India. So if your question has PSC and it doesn't mention whether it's redeemable or irredeemable, then what do we assume? We would assume redeemable. If your practical question says that preferential capital is irredeemable, but it doesn't specify cumulative or non-cumulative, then we will assume cumulative. Clear? You will take these two assumptions in questions. And when I will take cumulative, then I will take dividend on accrual basis. And I have told that whenever I talk dividend, listen carefully in AS 33, then it means I am referring to irredeemable PSC. I hope you all are getting this here, right? And if I talk about finance cost, okay, finance cost here, then it is referring to redeemable. We had already formed this concept in the beginning. If the question is silent in nature, then it is redeemable, right? If you are given irredeemable, but cumulative or non-cumulative is not mentioned, then cumulative. And students, I have taught you both the things. Okay. First lecture was over. We came to the second lecture. Second video starts from here. And I started adjustment number 2. What is being adjusted? Preference share capital. We first discussed the dividend in preference share capital. No dividend in redeemable. It is in irredeemable. It will go as per cumulative, non-cumulative. Adjustment of preference share capital is not completed. See second point. Premium or loss on early redemption of PSC. Let's assume your preference shares capital is redeemable. Your preference shares capital is redeemable. Its period was 20 years. I hope you are getting it. The company has redeemed it in 15 years, right? We asked the preference shareholders if we could redeem them early. Everyone agreed to give money. If the company has done an early redemption before time, then sometimes at the time of early redemption, then it will pay some premium. I hope this is clear. Those who are preference shares holders, if they get the money before time, they may face income loss in the future. The company wants to get rid of its burden of coupon rate. Suppose the company has collected money from somewhere. Now students, the company is reducing its burdens. It has announced a premium and proposed early redemption. Here, IND AS 33 says that if you redeem your preference shares holders before time and then give them some premium, then in that case, whatever premium you will give it will be a loss. That loss as per law, you can write off from security premium or do it from any other reserve in your books. You can do what you want in your books, but in AS 33, we'll count that loss in calculation of earning available for equity shareholders. Clear? Okay. Income minus expenses minus tax expenses, and then again we will do minus here on premium on early redemption. You may have set off this premium from any reserve in your accounting books. But students, when we will do the EPS calculation, we will carry this burden on our earnings. When we consider this preference share capital under Ind AS 109 as financial liability, we must have applied amortization method on it. Then what we will be doing? We will be making a PSC account. Then the interest would be due from IRR and market rates, and we would be paying from actual. Carrying amount is changing every year because the interest due is at a different rate and it's being paid at a coupon rate. So the carrying amount changes every year. So when we do early redemption, then we will take carrying amount from the books to see carrying amount of the PSC. As per amortization method, and how much money are we giving it? So the amount paid minus the carrying amount, that difference is called loss on early redemption or premium on early redemption. So you can take that premium anywhere from your accounting books. But students, in EPS you have to subtract it from profit. Earnings per share is a disclosure. All calculations of disclosure are being done out of accounting books. This won't affect your double entry system. Do anything in books as per law. But in EPS, you will have to count it as mentioned in Ind AS 33. As per provisions of Ind AS 33, loss on early redemption, if any, of PSC will be adjusted while computing EAE for EPS purpose. Okay. Now it may be possible that such kind of loss has been written off from securities premium or from other reserves as per law. But for EPS purposes, it will be routed through P&L account. It means that there will be no changes in accounting books, but it will be considered for disclosure purposes only. Consideration paid minus carrying amount of PSC. This will result in loss and you will take this loss through P&L. This is second adjustment that we learned. First of dividend, second of early payment, then we covered third concept. Third adjustment was loss on early conversion. This is written incorrectly. Conversion sometimes we tell preference shareholders that we will give them equity shares, and nature of preference shares is convertible. So we told them that we would convert them in 15 years, but we converted them in 10 years only. When we do early conversion, there may be difference of fair value per share. Based on shares of fair value that we promised that we will give you shares at this rate, but we are doing early redemption, so the share value may be different. So fair value of issued shares minus fair value of promised shares, that difference will be considered as your loss on early conversion, and we will treat it the same way as we discussed above. So whether you do early redemption or early conversion, in both cases you will have to route that loss through P&L. Look here, as per the provisions of Ind AS 33, the loss on early conversion of PSC shall also be routed through P&L for the purpose of calculation of EPS. So now how will we calculate loss on early conversion? Fair value of shares at the time of conversion minus fair value of shares as promised. The company believes that the fair value of the shares is increasing, so we should convert it before its conversion time. If we wait till the promised date, then share of company would have appreciated more than needed. Company could suffer loss. Early redemption is done at today's fair value. That's also more. A little loss occurred due to that. So you can put it in P&L. We have discussed all these points in detail one by one. I am just revising it for you. Then we discussed adjustment number 4. Now adjustment number 4 has come. It was about increase and decrease in rate of dividend of PSC. It is very, very important. Let's start this. When I say dividend, I am talking about irredeemable. I am not going to repeat this again. Company has issued irredeemable preference shares on the discount. The company issued irredeemable preference shares at the premium, on discount and on premium. This concept doesn't prevail in India, but we will discuss it because of exams. We are copying the English. Okay students, now irredeemable preference shares. If there are issues with discount, this means the company has faced loss. The company has taken less money. If the premiums are low, then the shareholders will suffer loss because they paid more money. So what does the company do? Sometimes it takes the effect of dividends on it. Did you all understand? Company issued its shares at discount. So they thought we are going to make a loss. Company had already stated that we will not be paying any dividends in year 1, year 2 and year 3. Because we are giving it at discount, so discount loss has already happened. So for first 3 years we will not give dividends and start from 4th year. Company has issued preference shares at premium. So they feel that it has taken more money from shareholders. So they told them that we will pay you more dividend in 3 years than the normal dividend. Did you understand, dear students? Your normal rate is 7%. We will give you 8% and we will compensate you for the premium. Is this possible? I have explained to you in class that if there is a discount case and company has not paid any dividend in year 1, 2 and 3 because of discount. So what will you do now? Whatever discount is there, you will divide it by the waive off period. You will calculate its amortization amount and you will deduct it every year thinking that you are giving dividends. And if company has given extra dividend of 8% instead of 7%, then till that extra dividend will go, we will add it back to profit. By thinking comparison has to be done, take normal dividend you have subtracted unnecessarily. If we don't subtract, we'll have to subtract it. If subtracted unnecessarily, add it back like we discussed. This was great concept. Study material had questions on this. We have done them all. So it may be possible that preference share capital is issued at discount or premium. Okay. If preference share capital is issued at discount, then it will be a loss for entity. But dear students, in vice versa situation, the premium will be loss for shareholders. But dear students, do you know sometimes entities pay low dividends or no dividends in initial years to compensate itself for loss. To compensate loss of discount that company suffered, company can reduce dividend or even cancel it due to discounts. Or if the company pays some extra dividend to compensate people because they paid a premium. Rate is increasing, decreasing. Now, in case the entity has followed above adjustments in dividends, then discount or premium shall be amortized in P&L for the respective periods in which such dividend adjustment has been followed. How? Amortized discount will be deducted from NP and amortized premium will be added back to NP. Dividend is not going because of discount. Amortize discount and subtract it. And because of premium extra is going, so add back extra. This adjustment is important. Then we covered adjustment number 5. Incomes expenses routed from security premium, other reserves. If any of your expenses as per the law was set off from premium or from some other reserve and it's not showing up in P&L. Let's say it's loss on sale of assets. They've set off from general reserve. They had legal permission. They used any other reserve for expenses and losses. It didn't come in P&L. That means it didn't come to EPS. Ind AS 33 says do anything in books. We have nothing to do with it, but for purpose of EPS routed through P&L, take its impact on profit and then calculate EPS. This point was discussed. If any expense which is required to be written off in P&L as per Ind AS has been written off from other reserves, then we will deduct all these expenses from net profit for EPS purpose. That is underwriting commission or any preliminary expenses. You have set off from another reserve. You have set off the security premium from the P&L and it should be reflected in the EPS. These are 5 adjustments that I told you. First, I told you the objectives, then types of EPS, and I explained the prominence of both EPS. Then we started basic EPS, then earnings available for equity shareholders. In this, there was adjustment in preferential capital. First redeemable and irredeemable, and under irredeemable, it's cumulative, non-cumulative. Early conversion, early redemption, and dividend fluctuation was told. And impact of some expenses that didn't come under P&L was explained. Then I started making you do questions. First, I made you do question number 3. You should revise question number 3. It was good. You should revise question number 2, question number 4, and question number 1. All these questions are important for you all students. So 2 videos are done, then we move to third video. We created this formula for EPS. This has been revised, and in this, adjustment of the PSC is very important. Students, now let's start weighted average number of shares, whose formula is very simple. What should we take? Number of shares. Outstanding. You have to multiply it by period of outstanding. I have explained concept to you. Suppose you have 10,000 shares on 1st. Now the company issued 10,000 new shares on 10th. It's important to count time factor on this. Money of shareholders is used for 12 months and you have used their money for 6 months. So simply it's 20,000. But now this EPS and this money that is given here, the funds are not even contributing 20,000 in this. Money of 10,000 shares is invested for 12 months. Rest of 10,000 shares is invested for 6 months. So now if we look at how many shares are supporting earnings, it's 10,000 into 12 by 12. 10,000 into 6 by 12. So this will be 15,000 shares effectively, which have contributed to your earnings. So when I do calculation of 10,000 for 2 times, this is called class-wise calculation. Now apply different time factor on opening balance and different time factor for new issues. This is called class-wise calculation. I told you date-wise calculation from 1/4 till 39. When an event occurs, just stop till there, okay? Event occurred on 1/10 till 31st of March. I had 10,000 shares. But then on 1/10, new share was issued, so I have 20,000 shares. So these are 5,000, these are 10,000. The answer will be 15,000. Do it class-wise or date-wise, the answer will be same. But as a CA student, as a professional, you should prefer date-wise calculations. And we have done all the questions based on date-wise calculation, okay? Whenever an event occurs, we take its time factor based on date and consider how many shares were there from certain point to another point. I had shares with opening balance from April 1st to September 30. New share was issued on October 1. So 10 plus 10 is 20 for 6 months. If another event comes in between, we would have counted till there. Team factor calculation is more important for you. The answer looks more professional in that. Weighted average number of shares outstanding during period, time factor. Example, we had opening balance of 10,000 and we issued new 20,000. So if you ask from 1 April to 30 June, July 1 to March 31. Earlier I had 10,000 shares, now it's 30 because 20 new have been issued. I will put 3 months on this and 9 months on this. See working? It's date-wise calculation. 3 and 9 months, the answer will come. Here we have. Second alternative is class-wise calculation. Take opening balance for entire year as 12 by 12 and new issue as 9 by 12. Answer should be same, but alternative one is preferred. Then I told you adjustments in weighted average number of shares. As we made adjustments to earnings available for equity shareholders, we made adjustments here. Point first was buyback of shares. When a company issues new shares, weighted average increases. If they buy back shares, it decreases. I had 10,000 shares on 1/4 and I bought back 2,000 shares on 1/10. So it's very simple. We will write 10,000 from 14 to 39. From 110 to 31 March, we had 8,000 remaining. New issue gets added, buyback gets deducted, we'll take out average value. This was case of buyback of shares. Examples are given on screen. You can see it. It's written in books. Okay, dear students, then I gave you this question number 7. Then we did question number 6. Did we started bonus shares? Yes, we did started bonus shares, right? We studied bonus shares in AS20. When a company announces bonus shares, no money comes in or either goes out. These are termed as free shares or gifted shares, okay? It is capitalization of profit in standardized language, converting reserves into shares. As per section 63 of Companies Act, it's allowed. Any company can capitalize its excess reserves if it feels that reserves are idle, so it can be converted into form of capital. But when we pass an entry, reserves account debit to share capital, this does not have any impact on equity. Cash doesn't come, investment doesn't increase, support for earning is not available. Only number of shares will increase for you. So I told you that for any question on bonus shares, you don't need to read the date. And don't calculate weighted average on bonus shares. Set aside bonus shares if you find it in any questions. First, take out normal weighted average, then opening balance, new issue, buyback. First, calculate normal weighted average, and then add bonus share directly. Calculate EAE and weighted average. But in the weighted average, directly add bonus share without time factor. Because it's non-cash issue, neither money came in nor earnings are supported, so why is it weighted average? If you have any issues with cash, then money comes in, which also supports your earnings. Company will do new things like build factory, bring new products because of increased investment level. But in bonus shares, neither money nor investment came, no contribution in earnings was there. Weighted average for what? So don't apply time factor. Earnings available for equity shareholders divided by WANS plus bonus. Share without time factor. This is formula. Direct addition, no time factor. Students, one more thing. Restate last year's EPS. Why? Last year you had 10,000 shares and now you announced 10,000 plus 10,000 bonus in 1:1 ratio. EPS of last 2 years is not comparable. This year you have taken number of shares in denominator as 20,000. So EPS will fall. Number of shares were low in denominator last year. If it's low, EPS is higher. If denominator will be high, EPS will fall. It's not comparable. So restate last year's EPS. Add bonus shares to denominator of last year and restate EPS and then compare it. We need to compare EPS of the 2 years. So take bonus effect on both sides. First, add bonus to weighted average of current year. Calculate EPS. Then students restate the EPS report that you submitted last year. So add bonus shares to number of shares from last year and adjust EPS and report that. And write in disclosures that we have restated EPS due to bonus shares so that comparison can be done. So students, we discussed this in class that let's say there are 2 years, current and previous year. Net profit is 10 lakhs and 10 lakhs. And the number of shares here are 10,000 and 20,000. Including 10,000 bonus shares. Profit level is same, but when you will calculate EPS. EPS will be high, here it will be low. Profit is same for you, but comparison of EPS is incorrect. Market price of company will go down. People will think EPS has gone down, but it hasn't. You just increased number of shares. So you can increase number of share and fix EPS. And we will restate this. I told you whole topic through stories and questions. So this was our inter concept. There was nothing new in it. I also told this in study material that there are two questions for bonus. One is correct, the other is not. And I corrected that answer. So in the new recording, I have assumed that 99% wrong questions are correct in the study material. I didn't do any corrections anywhere. I said if it's A in study material, then A. If it's B in study material, then B. If it's 2 plus 2, 3, then 3. So students, listen, when I recorded first batch and when I recorded second batch, I was very careless. How would I know what students think? I was thinking that these are CA final students. I have corrected all the mistakes. Children said the answers don't match. We did the third recording. I said to leave all other things. If 2 plus 2 is 3, I said 2.5, okay. Everyone knows 2 plus 2 is 4. If it's 3 in study material, write 3. But sometimes it just goes too far when there is no chance, even 1%. Then I have to say that I am helpless. They have written 2 plus 2 as 23 in place of 2 plus 2 is 3. Now this is wrong. So I've corrected that question. Okay students, so this bonus point is now a restatement of the previous year. Impact of bonus share on previous year EPS as per the provisions. Main objective of int AS is to make a comparison between the operating results of the two financial years. Previous year EPS should be restated by assuming bonus. Share in previous year without considering time factor. Consider that bonus share were issued last year also. You have done comparison, so the denominator should be same. You forgot the logic behind it. Bonus shares are given from reserves and surplus. Which reserves? It's accumulated reserves. That accumulation is not new. It is here and was there last year also. Company could have taken this decision last year rather than right now. What's in that? Whether you consider current or last year, it doesn't matter. We have accumulation. Okay, now the time for logic has gone. Now it's time for revision. I've told you all the logics. So now this was question 10, this was question 8, this was question 9. Now this was question number 12. 4 questions are done, then we came to partly paid up shares. Oh, it's video number 4. Okay students, so I had to make you all revise 3 videos and they are done. And in next video, I will make you revise video 4, 5, 6. Thank you students, love you, take care, God bless you all, bye bye. Hello friends, how are you all? I hope you all are doing well. I am very good. Yes dear students, we started revision of Ind AS 33. Do you remember it? Yes or no? And in previous video, I had revised lecture number 1, number 2 and number 3. A total of 3 lectures were revised. Right students? So today I am going to revise 2 videos because there are a lot of concepts in these videos. And then remaining parts, that is lecture number 6, 7 and 8, I will do it in tomorrow's class. So today we will revise 2 lectures. Right now we are at lecture number 4, okay? Where did we leave in last video? So students, we have started revising calculations of basic EPS. So students, there were 2 things. One was EAE and the other one was weighted average number of shares. So, one thing was important in earnings available for equity shareholders, and that was preference share capital adjustment. Redeemable, irredeemable, cumulative, non-cumulative, early redemption, early conversion, we have done all these things, right? So then I have started revising the weighted average number of shares, is that right? I told you a simple thing, the number of share outstanding during the period of outstanding. We can do class-wise and date-wise calculations, but we will prefer date-wise. Then I started making adjustments in it. First was buyback of shares. If a company buys back its shares, then weighted average will be less. We will adjust it by buyback date if we will issue new. From date of issue, number of shares increases. from date of buyback number of shares decreases. We have revised this. In bonus share, most important thing is don't look at bonus issue date, don't apply time factor. First, you will calculate normal weighted average, then add the bonus share directly to the denominator. And one more thing was mentioned, that EPS of last year will also be restated. As denominator increases because of bonus share, you will find the current year's EPS less as compared to the previous year. So add bonus shares in the previous year as well, and then both of the EPS should be ex bonus. The EPS of last year is before bonus. That cannot happen, and this year's EPS cannot be after bonus. Make both after bonus or ex bonus. For that, we did the comparison by adding bonus shares to the denominator. We did till this. Now we have come to the adjustment number 3. Partly paid up shares. And if in case any company has partly paid up shares, okay, on 1st April the company has 10,000 shares. It is 10 for each share and fully paid up. The company made a new issue of 10,000 shares on 1st July. However, paid up is 5. It is possible the new issue done by the company may be partly paid up. It will be difficult to calculate weighted average. So in AS 33 says that your partly paid up shares, first convert them into fully paid up. How much would these shares be if they were fully paid up? Don't calculate the weighted average yet. What does this mean? There are 10,000 shares. Paid up is 5 rupees. If these were of 10 rupees, then there would have been 5,000 shares only. So the partly paid up shares are 10,000, but equivalent to fully paid up shares are 5,000. So this is the first step. Convert the partly paid up shares into fully paid up shares. Find weighted average. How to calculate weighted average from 4th April to 30th July. Opening balance shares are 10,000, 3 by 12. From 1st July to 31st March, 10,000 plus equivalent 5,000 shares becomes 15,000, 10 old, 5 new, 9 by 12. This comes as weighted average. So whatever shares you will put in weighted average, they should be fully paid up or equal to fully paid up. Okay. And when weighted average is calculated, you know the next procedure. You just need to apply this formula and calculate the basic EPS. You also know that compliance of Ind AS is done for the listed companies or for unlisted companies with net worth above 250 crores. So these companies don't have the concept of different face values. Paid up values can vary. So they explained us how the process is. See this. The first step, first of all, we should convert all the partly paid up shares into fully paid up shares. Before calculating the weighted average, what is the formula? First, we took partly paid up shares, which is 10,000. Multiply it with paid up value of 5 rupees divided by face value, which is 10,000, equal to 5,000. Same formula. When this process is completed, you calculate the weighted average and apply time factor. Third is basic EPS. After that, you know the process. First, I taught an example. First, I gave an example. Initially, it was 60 rupees. Final call of 40 rupees. I have explained you step by step. If we talk about this example, so first I have 2 lakh shares, 100 each and fully paid up. There is nothing to do. 1 lakh shares, 100 rupees each, 60 paid up. Take 1 lakh shares, multiply by 60. Divide by 100, what will they be equivalent to? 60,000. Then received the remaining call of 40 rupees. We will take 1 lakh shares, multiply by 40. This comes to 40,000 shares. Now this becomes equal to fully paid up. Take the time factor from 1st April till 30 June. Next from 1st July to 30 September. Next event is on 1st October. So from there to 31st March. Here I have 2 lakh shares. Then 2 lakh 60,000. Here it has become 3 lakhs. Just apply the time factor, you will get weighted average. We have done all these questions in class. I am not teaching anything new, just reviewing. Why do I keep saying this? Because students while revising often think I didn't solve questions. Everything is done and is in your notebook. One example, then 18th question was done. After that 17th question was done. Then I came to fourth adjustment. First adjustment was buyback, second bonus share, third partly paid up shares, fourth was shares with differential dividend rights. The company does not have shares with different face values, as the SEBI does not allow listed companies. Company has one market price of the share. But it could be possible that the company has created some classes or maybe categories of the shares and have given them different dividend rights. It is possible that a specific class of shares has a special dividend right. For example, generally if the company gives a 10% dividend, you might get an extra 2%. If they are getting 8, you will get 10. If they will get 10, you will get 2% extra. You told to a class of people to give them 4% extra for normal dividends. If the normal is declared at 5%, you will get 9%. Normal dividend declared 10%, you will get 14. To a class of shares, if you have given any special dividend rights, then this concept will prevail. So, it will be given in the question that this class has extra dividend rights compared to the normal dividend. So, here the Ind AS 33 says, do not worry. Adjust your number of shares according to the dividend rights. Okay, so let's say I have a class A and a class B and one is class C. You have to give normal dividend to A. You have to give 20% extra to B. And you need to give 50% extra to C above normal dividend. So what will we do? We will consider their weights as 1. This is 1.2, this is 1.5. First you will adjust the number of shares according to their weights. Because their income share is high, their share is even higher and they will share normal income. So first you need to adjust the total number of shares as per their dividend rights. Then we will calculate equal EPS. Once you find the equal EPS, then we will consider it as normal EPS. 1.2 for them and it's 1.5 for them. Then we will show that EPS reconverted class wise. If in any question, if you get a case of different dividend rights, first of all you will have to adjust the number of shares. Because when the feature of number of shares is not same, how can you calculate the weighted average by clubbing in the denominator? First we will adjust the number of shares as per their dividend rights. With more dividend rights, their number of shares will be assumed higher. First we will calculate the equal number of shares, then equal EPS. Then we will reconvert that EPS. How much for normal for them and for those. Okay. We did these questions in class. These are not stories. We did question number 19 in class. In the question it is given, it may be possible that company has promised different dividend rights to different shareholders. Okay. If any equity holder has special rights for higher dividends in compared to other shareholders, then number of share shall be adjusted according to normal shares before computing weighted average. We will adjust the numbers. You can refer to question number 19. Then we came to adjustment number 5. Adjustment number 5. We are discussing business acquisition. When we talk about business acquisition, it is 103. When we talk about 103 acquisition method, we will have to read 103 for business acquisition. And 103 discusses the acquisition method. where assets at fair value and liabilities are taken over at a fair value. It could be possible that the company whose EPS you are calculating, that company might have acquired the business of another company. So if a business acquisition has happened, then certainly shares must have been issued in the purchase consideration. If you acquire a business from a company, you will give them shares in the PC. If shares will be given in PC, then new issue will happen. And if that happens, it will come under weighted average. We know there is an acquirer and an acquiree. The acquiree sold the business and left. So our focus is on the acquirer. Acquirer took over the assets and liabilities and issued shares in exchange. If issued the shares, how will this come in weighted average? So here Ind AS 33 says, nothing to worry about. The shares which you have issued in the acquisition method. Assume that as a new issue in weighted average, 1st April and 1st October, we apply 12 by 12 on April and 6 by 12 on October. Just like a simple case of new issue, treat it like that. Because the acquisition method is a fair value method. So, you must have issued the shares fairly, so there is no problem. Apply 12 by 12 factor to opening balance, and if the acquisition was on October 1, then 6 by 12. Think of it as a simple case like a new issue. There is no special treatment in this. So the shares you would have issued to the acquiree in the purchase consideration settlement, just assume it like a new issue. There is nothing to be considered special. See this. If an acquirer entity issues new shares in settlement of PC to the acquiree company. See here, to the acquiree company. Then we will consider these shares in a weighted average from the date of acquisition of the business. We have the solution of question number 22 and we have done it in class. 6,000 shares increased to 10,000. Simple time factor. Nothing special. We have done question number 21. We had discussed this in class. Adjustment number 6. Share split, share consolidation. Share consolidation is also known as a reverse share split. Share split and reverse share split. Okay, so let's suppose a company has a share and that too for 100 rupees, but I convert it into 10 shares for 10 rupees. What is this called split? I have a 100 rupees note. I got it changed. I made 10 notes of 10 rupees each. Overall wealth is still same. One share converted into 10 shares. Earlier one share was worth 100. Now there are 10 shares of 10 each. So the denominator will increase 10 times. If a company goes for share split, then number of shares in its denominator will increase within the split. Same problem as of bonus share will arise. EPS falls with increase in denominator, making it incomparable to last year's EPS. So, what do you have to do? First thing is don't check the date of share split. Consider this is happening at the beginning of the year. Split date will be given in the question. In split, don't look at the date, means the time factor. If you do split on first date, or on 1st April or June or July or August or in March or in February, it does not matter. First, don't check the date in the split. Secondly, you have to assume that the split is happening in the beginning of the year. Because nothing is happening, there is no cash flow. It is non-cash, you've just increased your number of shares. So what will we do? We will assume that the number of shares, these 10 shares which are splitting, they are splitting off in the beginning of year. No need to apply time factor. Time factor means that if it is July, don't do 9 by 12. 6 by 12 in October as it is non-cash. Consider this 12 by 12 logic. Bonus share logic. And one more thing in last year also, you have to consider the share split in the denominator. So, adjust the number of shares of last year as per the split. Convert 100 rupees last year's number of shares to 10 rupees. As we have to compare EPS and comparing an EPS of 100 rupees to 10 rupees is not possible. As the previous year's EPS was as per 100 rupees and this year's EPS is as per 10 rupees, it is not comparable. So restate the last year's EPS. If there is a bonus share, then also, and if it is split, then also restatement will be done. Just do the vice versa. Vice versa means I had 10 rupees worth of shares. What I did, 10 rupees into 10. Okay, converted the low denomination to high denomination. It will be a vice versa case. Last year the number of shares was more. This year it has decreased as you have made the 10 rupee share 100 rupees. When the shares will be low this year, the EPS will be high. Last year's EPS will be seen low, which could influence decision making. It is the same process. You don't have to read the date. Assume everything at beginning of year and you need to calculate last year's EPS as per share consolidation. So we can compare EPS of 2 years. We have discussed this in class. Split and reverse share split. See this here. We will ignore the date of split or reverse split. While computing weighted average, we will assume that company has changed denomination per share at beginning of the year. Okay. Next, the entity will also restate EPS for the previous year by changing the number of shares in denominator. Assuming such split has taken place in the previous year, because EPS needs to be compared or else the investor will take unreasonable decision. We are doing this for investors' decision making. Then I made you do number 20, taught the concept. Then did a question. I did not tell any story. What we did, adjustment number 7. Then we studied adjustment number 7. First adjustment, buyback. Second was bonus shares. Third was partly paid up, and fourth was different dividend rights. Okay. Fifth was business acquisition. Sixth was share split, and which was 7th, right share. If a company has issued right shares, then I told you 4 steps. The first thing, find X theoretical price. How is this price calculated? We had a simple formula. Take number of shares before the right and take the market price which was before right. Now here we are trying to find out what was the shareholders' wealth before the rights issue. Right issue is always done at the cheap price because company is bound by law, will first offer to existing shareholders before issuing in market and offers them at lower price than the existing market price. I had also explained in class that why they offer at lower price, because if company issues in the market, then it has to bear flotation cost of advertising and many other. So the company says we will get less money anyhow, so give the right shares to existing shareholders only at a discounted rate. Company is doing well. Thus, don't add new shareholders. The expenses that you have to bear outside, give them at cheaper rate instead. I had explained you the concept why the right issue price is cheaper. So what are we doing now? We are looking at the wealth before the right issue. What was the shareholders' wealth before right? Original number of share into market price before right. This will be total wealth before right. Cheap shares will be added in this. Which one? Right share into right price. The shares we issued in the right issue and the offered price. These are expensive shares, these are cheaper shares. The average price will be reduced on clubbing them. Assume that one share was worth 250 rupees before right. You offered for 200 rupees in the right issue. So for share worth 250 rupees, 200 will be added, then overall wealth will decrease on average. So the tax rate means post right. And here we are trying to ascertain what does an average price post right comes up as. So this is the wealth before right and this is wealth at right. This is total number of share. We will know what is an average price of one share post right. It is called X price. Then what will we do? Move to the next step. This is called the RA factor. Clear? Right adjustment factor. We want to know that the price before the right issue and the price after the right issue, what is the variation between the two? Pre-right market price Market price after right. We will get RA factor. I am calculating this to adjust the number of shares. Suppose the beginning of the year from 1st April and the rights issue was on 1st July. Okay, so April, May and June, these 3 months. So our market price was the pre-write one. And from the 7th month it became the post-write. Didn't understand me? This is the come write price, this is our ex write price. Variation in the year. From April to June, the market price was come write price for 3 months. But from July to March, it became the ex write price. Come write price shares cannot be clubbed in shares with ex write in the weighted average. So the 3 months of come write price needs to be adjusted. So if I multiply this by RA factor, then my come write period will be converted into the ex writes one. Okay, RA factor is calculated. Suppose the right issue is done on 1st October. It means shares were come right for 6 months and after that became ex rights. You cannot include the come right and ex rights in the weighted average. Then what we need to do? We need to convert the come right period to ex right period. Existing situation is ex right. So if you multiply the old 6 months with the RA factor, then you calculate the variation. We have understood this. First step is to get the ex right price. Second is effect RA factor. We adjust number of share in weighted average when we will calculate it. So then we will multiply the number of shares by RA factor and then apply the time factor. Which one? Before write. But when we get to after write, we will apply the time factor on shares. We don't need to apply the RA factor because this period is the one with the ex write and there is no issue in this. The issue is in the period with come write. Because the wealth is higher before write and it reduced after write. So this come write period has to be adjusted with RA factor. One more thing. We also restated the last year's EPS. Because there wasn't any right issue last year, the number of shares in the denominator of last year's EPS, they are come right share, multiply that with the RA factor and restate the EPS of previous year. This whole wherever the bonus element is and wherever your prices are varying, like bonus shares, they are free of cost. Restatement in last year, if it is split or reverse split, then also restatement if right is being issued. Price variation in right issue of come right and ex right, then also EPS of last year. Let's say like last year's EPS was come right and this year is ex right. You need to use RA factor to make come right the ex right. You must find the variation in price, otherwise you can't compare to EPS. This entire concept step by step in detail with proper time and efforts has been explained in class. You know how I teach? I've never spoken as fast as I am right now. I've never taught in this fast speed. The students see my videos at an increased speed. My content is of 400 hours. For namesake, students finish the videos into 50 hours. The students who have taken the class knows that I teach at a low speed and they watch videos at increased speed. My motive is to clearly teach the concept, but it is the responsibility of the student to retain it. If a student took a class, studied and didn't revise for a year, concept gone. This mistake happens, students take the FR class first and never revise it, then the concepts will be out of link. Same applies to me. If I don't record for 6 months and stop teaching, I will also forget how to teach. I keep on recording some concepts, so the link is there. This applies to everyone. If Virat Kohli won't play for 3 months, he will be out of form. This is practice, students. If you keep practicing and revising, concepts become strong. We have studied all of this. See, step 1, find X right price. Second step, find RA factor formula. Then third step, we move to the third step. This adjustment factor which we calculated, apply it to the number of shares. Which one? which were outstanding pre-write, on original shares to make them ex-write, from pre-write while computing, from come rights to make the ex-write you will use the RA factor. Now look at the fourth step. Restate the EPS for previous year by adjusting. Restate the EPS of last year and then apply the RA factor to the weighted average of previous year so as to make EPS comparable on an ex-write basis. Then we did question number 14. Question number 14. Then we did another question. Question number 4. Okay. And this video was done. The video number 4 was quite lengthy as we discussed a lot of points. In the weighted average number of share, we did 7 adjustments in the basic EPS. 7, right? First was buyback. Second was bonus. Third was partly paid up. Fourth was your different dividend rights. And fifth was business acquisition. Sixth was share split, reverse split. Seventh, rights issue. Then we moved to video number 5. So this was our video number 5. And in this video, I started with the explanation of diluted EPS. Since everyone knows what is diluted EPS, let's revise it quickly. The simple meaning of diluted EPS: reduction in basic EPS. Reduction in basic EPS. It means if you think that the company's basic EPS will decline, in that case, it is diluted. If you think that basic EPS will increase, it is anti-dilutive. When? In the future. Okay, so today we have reported the EPS based on the current year's profit. So the EPS we report based on the current year's profit, that is basic EPS, and it is also called as the current EPS. But there is one expected EPS for future predictions. A company informed its shareholders that today we are earning 250 rupees per share. As per Ind AS 33, if you are showing today's position, it is your responsibility to tell your shareholders about the future position. But how can company tell about the future? They are not astrologers. The Ind AS 33 says we are not asking you to expect anything. You do one thing, just check how many potential equity shares you have. And what effect will it have on your EPS? But we don't know what are the potential equity shares. These are the shares that are not equity shares today. But as per the company's commitment, they will be certainly converted into equity shares in the future. If the company has promised that in future, they will distribute equity shares to you or to X or to Y, the company could have done various commitments. So, when it will be converted to equity shares, the number of equity shareholders family will increase. The number of shares in the denominator will increase, which means that the number of people sharing the profit will certainly increase. So, it is possible that the EPS people are earning today might not earn in the future. Okay, suppose I have only one child and I have 100 crores. So, all the money belongs to him. If I have 2 kids, then it will be divided 50-50 crores. And if there are 4 kids, then distribute 24 crores each. If the people who are sharing the wealth increases, then their share will automatically decrease. If you think that in the future the number of shares will increase, then what does it mean? Number of shares will increase means when the number of shares increase, the profit share will decrease and EPS will decrease. You have to inform the earnings to shareholders. And because of the promises, what will the company has to face in the future? I have explained this previously. I am just revising it. Convertible preference shares, convertible debentures, ESOPs of the company, share warrants of the company. The contingently issuable shares of company. The company has made numerous promises. Promised the debenture holder of converting his debentures into shares. Promised preference shareholder to convert preference shares into equity shares. And promised the employees to give them ESOPs. In future, when all these promises will have to be fulfilled? People will ask for the equity shares, then the number of shares issued will have to be increased. When the shares will be issued, the shareholders will increase, which may decline the EPS. So now tell us that what will be the effect of that commitment today. Then Ind AS 33 says that all the potential equity shares held by the company that entitle or may entitle equity shares to its holders. There is no equity share today, but it will become in future. We will take into account all these promises to the basic EPS. Now check where the EPS stands, and if you feel that the basic EPS has declined, then that is called diluted EPS. And if you think that after adjustment EPS will further increase, that is called anti-dilutive. If you think EPS will increase in the future after all adjustment, that is anti-dilutive. You don't have to disclose it. As a matter of prudence, we have to show the decreasing EPS and not the increasing one. Basic EPS is 5 rupees. In future it will be 4.9. So we will report 4.9. Today you are earning this much and you will earn less in future. But if it is coming 5.1, then write nil. Writing nil is also a positive disclosure. Not having a dilution is also a positive disclosure. Today my basic EPS is 5 and nil is written below. This means there will be no decline in the future. It can stay same or increase. This is also a positive disclosure. So in the diluted EPS that we have, we will make adjustments in basic EPS. And we had initiated the discussion about all the potential shares one by one, right? I had told you this same thing. Look, first of all, as per the provisions of Ind AS 33, diluted EPS means reduction in basic EPS due to the potential equity share. As per the provisions, potential equity share is a contract which entitles its holder or may entitles its holder equity share in future. Convertible ESOP, warrants, options. I taught you to adjust all of these, right? Then we saw formula, adjusted. To make adjustments in earning and to make adjustments in the weighted average, you'll have to learn it. Okay, now if you think if basic EPS gets increased after considering potential equity share and after the adjustment of your promises, if you feel that EPS has increased, then that is called anti-dilutive and you should not disclose it as a matter of prudence. Everything I am saying, it's written in the notes. Then we started making adjustments in it. Adjustment number 1. First adjustment is of convertible instruments. Let's start the adjustments in diluted EPS, and the first adjustment is of convertible instrument. They can be either convertible debentures or convertible preference shares. So first of all, what did we discuss in class? That conversion is of two types. One is a mandatory conversion and one is optional. See this on screen. One is a mandatory conversion and other is an optional conversion. Mandatory conversion and optional conversion. The meaning of mandatory conversion is a debenture holder or a preference shareholder does not have any choice. They have to take the equity shares. There is no choice. But he has two choices in optional. If he asks for share, then he will get the share. If he asks for cash, he will get cash, but it's his choice. The treatment is different for mandatory conversion. And for optional conversion also, the treatment is different. So there are two adjustments, mandatory conversion, optional conversion. But before explaining the concepts of mandatory and optional, I explained one thing about Ind AS to you, and that is compound financial instruments. I had told you that whenever the topic of conversion comes up, whether it is mandatory or optional, then you need to split off the instrument into the liability component and into the equity component. So you have to split off all the convertible instruments. Now, first of all, we need to identify the liability component. For that, first identify the cash outflow. How much payment you have to do in cash in the instrument. if it is a mandatory conversion case. So what do we do in this? Just the coupon rate. Let's say I have 10% debentures and they are mandatory conversion ones. Even if you don't take the principal amount, you have to pay the interest every year. Note this down one by one. That it's cash outflow. Discount it at the market rate. If we discount it at the market rate, we will get the present value, which is called liability component. The amount you have to pay out as cash outflow, its present value at market rate, is the liability component. So the balancing figure becomes the equity component. Clear? But when we talk about optional conversion, in the optional conversion, you need to take interest outflows and also the principal outflow, because in optional conversion, you might have to pay the cash clear. In financial instrument, in the definition of financial liability, we call it contractual obligation to deliver cash. There is a possibility of cash delivery in this. We will consider it. We will discount all the interest outflow and principal outflow, and we call its present value as liability component. I mentioned one more thing. In mandatory conversion, liability component is less. The equity component is higher because this does not include the principal. But the liability component is higher in the optional conversion because of the discounting of the principal. But I had advised you to split off. All convertible instruments, whether mandatory or optional, need to be treated as a compound financial instrument and need to be split off accordingly. And the students had also asked that the interest payment, suppose if the interest payment is 10% and if it is to be paid on the company's discretion. If the company wants to, it will give or else not. Practically, it is not possible to invest money in the company if the interest comes under company's discretion. And interest obligation also ends, then you can't find its present value. Then everything will be an equity instrument. How will you calculate interest outflow? But it does not happen. Understood? So you have to split it off into liability and equity component. We have done an example also previously that we apply amortized method on the liability component. Interest was due and then it was paid. It's finished. Now only the equity instrument remains in the end. This is it. So we did an example of split off also. First of all, we learned to solve it as per 109. In 109 it says, I have 10% of the instruments worth 10 lakhs rupees. The market rate is 12%. We need to do the conversion by the end of the third year. 1:1 ratio. One share for one debenture. So 10 lakhs rupees at 10% rate is 1 lakhs for first, second and third year. And we discounted it at 12%. Here we have its liability and equity component. And optional conversion is not mentioned. If it is not optional conversion, we have taken it as mandatory conversion, as optional is not given. We can give cash and shares, but conversion is mandatory, hence the higher equity component. Then we passed this entry by doing split off of 10 lakh debentures. This is the initial recognition, and then we created an account of the liability component. I clearly explained you how the working is done. It was due, we paid, then again, therefore the account is closed. Now this equity component is left, we will convert it. This was about 109. What to do in EPS now? What to do about the mandatory conversion in the EPS? As I explained you in class, that when we talk about mandatory conversion, so in this, the debenture holders and the preference shareholders do not have the option to ask for the cash. He will have to take the shares. So how is it connected with the potential equity share? As per the definition, a potential equity share is a share which will become equity share in future. That entitles or may entitle, but according to 109, this is an equity component. There is no choice. This is certainly an equity share. Ind AS 33 says this is certainly an equity share, and take it in the basic EPS. Okay, now in the case of mandatory conversion, see this example. I have an opening balance, then I issue a new one, Okay. On 1st of October, the company issued 2000 mandatory convertible bonds. Okay. And they are convertible into equity shares. 10 shares for one debenture. We have 2000. From one, we will make 10, so we get 20,000 shares. So consider this in basic EPS from 1st April to 30th June, and from 1st July to 30 September, and from 1st October to 31st March, there are 10,000 shares. Here this has become 20,000 and then 40,000 here, right? It is not connected with diluted EPS. Mandatory convertible shares are not included in the diluted EPS. As soon as you issue the bonds, start taking them in basic EPS by converting them in shares, and you don't have to think of the mandatory conversion. Look here, after this comes optional conversion. We took a little time in the optional conversion. Again, I will slow down my speed here. We have a lot to discuss about this. When we talk about optional conversion, and we have also told the debenture holders and the preference shareholders that you can either take cash or you can take shares. So because of taking shares, because of the option of shares, it may be possible that you will have to issue shares in the future. If the issue of shares is confirmed, then it will come under basic EPS. But we have the option. It may or may not be issued. So what you will do is you will show its impact on the basic EPS, that if you have to issue shares in the future and the number of shareholders increases, then how much decline can be seen in the basic EPS. Because this is certain that the shareholders can increase in the future, there is potential of increase in shares. So I had told you 2-3 steps for this. First step, in the case of optional conversion, you will first calculate the incremental EPS. What is incremental EPS? So remember, you've split this off into a liability component and an equity component, right? You are paying interest on liability component as per the market rate. Now what will happen if we convert it today? Then we will not have to pay the interest. When debentures will no longer be your debentures, then you will not pay the interest and will start to save. Okay, first you calculate the savings. Savings in interest bracket net of tax. So the interest that is in your current year of P&L, all of that will be saved. So suppose if I convert my convertible debentures today only, that will save my interest. So the interest that is in your P&L, that is your savings net of tax. Saving interest means higher profits, increased taxes, so you have to pay net of tax. If no tax rate is given, take full. Then divide this. And that is the promised number of shares, which means the number of shares you may have to give. As a result, how much will be saved because of this? How much will the shares increase? We will get the incremental EPS. How much savings can we expect because of the convertible instruments? When the debenture is not considered as debenture, then no interest will be paid. So in the current year's P&L, we will save all the interest that was to be paid. For the impact on current year's EPS, see in current year's P&L how much interest you have paid, that is your savings. On dividing by the number of promised shares, you will be able to get its incremental EPS. And I had said you can't avoid incremental EPS as it is a mandatory step and you have to do it. Because this gives us an idea. See, we have calculated the incremental EPS. Now compare this incremental EPS with the basic EPS. If you think that the incremental EPS is lower as compared to the basic EPS, this means that impact of incremental EPS will dilute the basic EPS. But if incremental EPS is higher than basic EPS, then you don't even need to go to the next step. You can just consider this as anti-dilutive and leave it. If the incremental EPS is less than the basic EPS, we will calculate the diluted EPS. If this is already higher than the basic EPS, means the incremental effect is higher, then the EPS will be anti-dilutive. So we will leave it. So I want to tell you that the incremental EPS is calculated to know if we should do the calculation of dilution or leave it. So the incremental EPS of potential shares. I will always calculate the incremental EPS and do its comparison with the basic. If it's less than the basic, then I will move on to the next step, which is diluted EPS. If incremental EPS is higher than the basic EPS, I will just leave it as it will be anti-dilutive EPS. If incremental EPS is higher than basic, it will increase once adjusted. If the incremental value is less than basic, I will go to the next step. So the next step is adding my savings to EAE. After this, in the weighted average number of shares, add your promised shares and calculate diluted EPS. Now, if the incremental EPS is low, so this will reduce the overall also. This was the basic EPS. This was the incremental and it was less than the basic. So overall it will be less and we are looking for the same thing. So I had explained this all. Incremental is mandatory. Okay. What did we do first? We worked on incremental EPS. If it becomes less than basic, then it should be considered as dilutive. If it becomes more than basic, then consider as anti-dilutive. No need to adjust these shares because we don't calculate anti-dilutive EPS. Don't proceed further. But if this is less, then calculate diluted EPS and go to the next step. Step 1, step 2, both are mandatory. And which step is this? Which step was this? See, calculating incremental. Second step, then adjust this and find dilutive. Then I told one thing more. You might remember that if the market rate is not given in a question, so you don't need to split off in the liability and equity component, as you won't be able to do it without the discounting factor. You get the liability component when you discount the cash outflow at the market rate. We can't find it if there is no market rate. You just solve it simply without split off. The process of splitting off this is only possible if you have the market rate, and if not, then on your debentures worth 10 lakhs with 10% rate, the total saving will be 1 lakhs. You should take the saving on liability component, and if there's no market rate, take it at full rate. It will be a simple question. We have covered this in class. We spent a good time on it and did some questions also. Look here, we wrote notes too. If question is without market rate, in that case we will consider saving in interest at actual rate. While computing incremental, suppose debentures of 10 lakhs at 10% rate with no market rate. So we will assume savings are 1 lakhs. First of all, we won't split off. No. The other thing, this 10% is our saving. Or would take saving by applying market rate on liability component. Okay, it will be a simple question, just like the questions at Inter, but there won't be such a simple question. Then we did question number 24. 24 is a very important question. Do it. Then 23. Look, this question also has a note. We could not split off the given instrument into liability components because the market rate is not given. The question without market rate, we don't split it off. Then we moved forward. We did 23rd. We came to point number 2. Convertible bonds. If you have issued in the current year, if convertible bonds you have issued when in the current year, didn't get it. Let's say the company has issued convertible debentures on October 1st. Tell me one thing, if a company has issued convertible debentures on 1st of October For how many months it would have paid interest? For 6 months. So just understand this one thing. You have to count your savings from October of 6 months. This will impact your current year's profit for the next 6 months. Consider savings of 6 months and take the shares of 6 months. The savings that you add to the diluted EPS is for 6 months, and the shares that you add, also you have to apply 6/12 time factor to it. If your convertible instruments were issued at the beginning of the year, then the entire saving and entire share. Whereas if you have issued them in the current year, then do not forget to put the time factor. Apply time factor on savings and apply the time factor on the promised share. I have explained this using example. You have the notes. If you are confused, refer to the notes. Then I told you that conversion during the year is not necessary. That issue will be during the year. It can be conversion also. Do you have any convertible debentures and you converted it? You will say, if you have converted it, then you should go to basics. No. Let's say that you did conversion on 1st October. Furthermore, the period before 1st October is for potential equity shares while actual shares is for later. Hence, this will come under the basic EPS for 6 months. This comes under diluted EPS for 6 months. Period before the conversion took place. If you have convertible debentures outstanding with you, then students, for the time it's convertible, it will show impact in diluted form. After conversion, it will be in basic. You have two adjustments. Time factor will work in diluted EPS and also in basic EPS. Hence, you have to make adjustments at two places for 6/12. But it will create issue. You have to keep this in mind. You also have to keep this in mind while conversion, but when? During the year. You should revise this information because both the points are important. Hence, when you will revise in AS 33, you have to carefully read the notes as there were many points in diluted EPS. Firstly, conversion, it's mandatory or optional. Mandatory will come under basic while in optional, it will be liability components interest. Add share on top and below. If you don't have market rate, then take entire interest. Don't split off if there's no market rate. Issue in current year. Take time factor in diluted EPS. Post conversion, we have to take both along with the time factor. Many things are crucial in the notes. Revision video gives an idea about what you have studied. However, actual revision could be done through your copy. Furthermore, when you will see in AS 33, then read diluted EPS carefully. This is important. It's very important. What is next now? Let's see, we completed both the videos. In rest of the videos, 6, 7, 8 will be completed in next video. I will do the revision of these 3 lectures in tomorrow's video. Okay. You have to read it carefully because in AS 33 is not like AS 20. This is little complicated. You have to practice questions here with patience, right? Thank you very much, students. I will see you in the next video. I will help you in revising rest of the lectures. Hello. How are you all? I hope you all are fine. I am also fine. We have already started the revision for Ind AS 33. So students, where did we leave last time? We learned and started making adjustments in diluted EPS while in the previous part, it was preference shares. I told you adjustments. And number 1 is treatment of preferential capital while computing diluted EPS. All the points related to preferential are cumulative, non-cumulative, redeemable and irredeemable. I told you all the points, early redemption and conversion. Today, we will move ahead with the same concept, whereas I'm at adjustment number 2 ISO. First adjustment was preferential capital. Second adjustment is ESOPs. No new concept is related to ESOP. You have been studying it from CA Inter. In the CA final, we read special chapter Ind AS 102, share-based payment. We studied ESOP in that too, right? I am not going to tell entire chapter. ESOP is known to all. Company offers cheap shares to employees. Company offers shares at concessional rates to its employees. Okay. If a single share costs around 180, while company is offering it for 120 with concession of 60 rupees for employees. And we want to find diluted EPS. We are finding diluted, not basic. So the money which company will get in future, the market price is 180 and you will get at 120 as it's an excessive price. The money company will get in future, company will put that cash in business, it will get benefit. How could it be diluted? So students, we don't have to think about the benefit company will get from 120 rupees. Our objective is to find diluted EPS and our concern should be 60 rupees. One thing is fixed, that the concession you are getting of 60 rupees. You will not get back 60 rupees, but you have to give shares. I hope you get it. Therefore, Ind AS 33 says that you should take out free share from your ESOP. Take the free content from ESOP. How will it be done? It was a simple equation. The market price was 180 rupees and exercise price 120 rupees. Therefore, students, it's evident from here that you have given 1/3 of your shares. You are getting concession of 60 rupees from market price, which is 60 by 180. So, you are leaving 1/3 of market price. If I multiply this with options, you will get your free shares. I hope you are getting this point. While the free shares which you have here will be used in your diluted EPS. But I told you one thing in the last video, to find increment EPS of every potential equity share is mandatory in 33. First, we will find increment EPS of this one. It's simple, savings as 0. What savings should be done in ESOP? Shares should be here and below. It is free shares. If it was a convertible debenture, there would be some coupon rate. You would have done savings. If it was convertible preference shares, you would also had savings at a fixed rate. But you don't have any savings in ESOP and you have to give free shares. So, its incremental EPS will remain 0, and because incremental is 0. First, let's use this one. This is extra diluted. Thus, it's clear that the incremental EPS is 0 and its impact will be diluted. Then we take EAE, right? Now we will add 0 to it and then take weighted average number of shares. Then we will add free shares and get the answer by doing diluted EPS. This is the formula. Adjusted EAE, adjusted number of shares. First, we will find incremental EPS and report to diluted EPS. This was all in ESOP. We have to target and move ahead with concession you gave. However, there is only one crucial thing, one issue. I explained you this very clearly. And it was, there was a difference of 33 and 102. When we do the ESOP accounting in the Ind AS 102. Therefore, here we will log the grant date of fair value. We will log. If I have announced ESOP for 1 for X1 and the marketplace on that day is 180 per price, the exercise price is 120. So, this entire accounting will be based on these prices over the testing period. Once we log the grant date of fair value, or subsequently if the market price fluctuate, we won't look at 102. While we do our accounting on the basis of employee left with 60 rupees ESOP. But 33 says something else. It says that when we find EPS, we find for 31st March, let's say vesting period is of 3 years. You need to understand that at the end of first year, furthermore, at the end of second year and third year, when you will calculate the free shares, it should be on the basis of average market price during the year. Okay. If your vesting period is 1, then you need to find the average market price for first year, and we want C180. Look at 102 in accounting. In accounting, we need to lock the price and calculate EPS. We need to give exact value. On every 31st March, when you have to find free shares, then will the formula be market price minus exercise price upon market price into options? No, it's not. Your formula will be average market price. If you are finding free share at first year end, you need to take average market price of first year. If you are searching free shares at end of second year, you take average market price for second year. Take average market price in third year. Means every year, the average market price and number of free shares will change. In all the 3 shares, you will have to take different free shares in diluted EPS. You need to remember this point. This information will be provided in question. Grant date of fair value and excess price gets locked in 102. Right, students? But in Ind AS 33 on 31st March every year, free share, you have to calculate based on the average market price. The average market price for first year is 190, for next year is 170, and average market price for the next year is 220. Free shares will be calculated based on average market price during the period, different for each year. You keep this in mind. We discussed this in class. Look here. Average market price minus exercise price upon average market price into ESOP. We are calculating free share, concessional share. Later, we will calculate incremental EPS, okay? Incremental EPS 0, then we find diluted overall. I explained you this working. Okay? Then we moved on. This was adjustment number 2. Now see students, we have done all these questions. 31 question number 3. Then we came at adjustment number 3. We had come to adjustment number 3. This was a very dangerous adjustment. It's already written, very important. This was the option, contracts for own shares. Let's say company's name is X Limited. We are finding the EPS. If this company has done option contracts on their own shares, the word is own shares, your own shares. If I'm calculating the EPS for X Limited and X Limited has some option contracts on its shares, then learning its adjustment is very important for you. I hope you are following me here. Students, I told you that you need to identify one thing from these two, right? Which is the first case? First find out which company's EPS you are calculating, okay? And whatever company has written option contracts on their shares, then first find if the company is an option buyer or the company is an option seller, okay? Why? Because an option buyer never goes into loss. The option buyer exercises the option only when he sees profit in it. I hope you are getting this, because option premium is given for this. Therefore, if we are calculating the EPS of X Limited, it had signed option contracts on its shares. This is an option buyer. If this is an option buyer, there will never be any loss in the future. Moment there is loss, he will say, I don't want to exercise the option. He has the right. The option buyer has rights. There is no obligation. This is anti-dilutive case. In profit, the option will be exercised and vice versa. The company for which you are finding EPS, and if that company is option buyer, then ignore the situation. We won't even talk about this issue, but what is our issue? If I am calculating EPS for X Limited, as per Ind AS 33, and this company has sold its operations on our own shares, they have sold option on its one shares. If this company becomes an option seller, they will be trapped in an obligation because the other company has already paid premium. Clear? They have the option premium. If this company has the option premium, then it's involved in obligation. We will have to work according to the intention of other company. You need to see if the company is an option buyer or option seller. If it is an option buyer, there is no case. Ignore the situation. It's anti-dilutive. We are not seeing profits. We are finding dilutive EPS in option buyer. The company will have profit in future, and if not, option will be dropped. There will be no loss. But if the company is option seller, then stop here. Now we need to move ahead. If a company is an option seller, there are two cases in option seller. If the company is an option seller, then there will be two cases that what option did company sell. Either the company sold call option or the company sold put option. The first case is that company has sold a call option. Now tell me, if the company has sold call option on its own shares, that means other has bought a call option. What is the meaning of call option? Right to purchase. That means other has the right to purchase company shares. Let's assume this is X Limited and Mr. Ram is in front. Mr. Ram is call option buyer. He is call option buyer and he has bought the right to purchase. Right, students? If this benefited him and he exercised option and he told the company that he wants to buy shares, then the company will have to give him a new issue. Company will sell shares means to issue shares. Let's say he did the option and wants shares for 140 rupees. When I checked the contract expiry date, the market price now is 180 rupees. Ram is smiling. Mr. Ram says that the thing which is being sold in the market for 180, he can buy it for 140. He has shown his intentions that he wants to buy company shares. What will the company do now? Today, one share costs 180 rupees. The company will have to sell for 140. It's the same ESOP case. They have to give at concessional rate and we have to take out free shares. The company will issue free shares. The free shares, the further procedure, saving is 0, free shares, your incremental EPS is 0, then include it in your overall ESOP trading will be done. Now, if the market price is 130, then Mr. Ram will say, if share is available in the market for 130, why would he buy it for 140? Then the contract will be void. He won't exercise the option. But if this is a call option case and the market price is high, so the option will be exercised, the company will have to issue it at a concessional rate. Because if the company will give 180 share for 140, it will be same case of free share. Second case is put option. What is the second case? Put option. The second case is put option. It means the other has the right to sell, right? If the other party exercise their right to sell their shares, the company will have to buy them back. Clear? The company has option on its own shares. If the other party has right to sell, then company will have to buy it back. Now you will say, how will this come under diluted EPS? It will come, let's assume, one side is X Limited and Mr. Ram is on other side. They have done contract of put option. Because I will sell your shares at 140 to you. The market price is 110 rupees. The thing which is selling in market for 110, and if he can sell it for 140, then he will say to the company that he can sell it for 140, and then the company has to buy it back for 140. Therefore, if the company has to buy back at 140, then there is an assumption for int AS 33, Companies Act, that when a company buys back its shares, it needs to issue shares. Either the company creates CRR or issues new shares. The company has assumed new issue that they will issue new shares to arrange money. When the company does new issues, then current rate is 110. Current share is 110. So what will the company do? First of all, 140. Into options, we'll find how much funds we need. Funds required. If buyback is at 140 rupees, we will see the number of options. Furthermore, we will find funds required. How much money is needed for the buyback, and if the company arranges this money at today's rate, how many shares will have to be issued. Now students, you already know how many shares are here and here. We have to issue more shares because we need more money as compared to 140, and you will get money at 110. Then arrange more and we need to issue more shares. So we will find the difference between these two. This is loss for company. If the company, the number of shares should be cancelled as per 140 rupees. Now let's say this option is for 200 shares, so the company will multiply 200 into 140. How much will it be when we multiply 200 by 140? 200 into 140 divided by 110. The company will have to issue more shares. Company will buy back 200 shares, but will have to issue more, then we will know the difference. Excess shares are being issued, that is the loss for company, while next step, savings new issue. These are free shares. More shares are issued and buyback is less. What is the difference? This is same free share case and this is their procedure. I told you this entire procedure by making cases. All these notes are written in the copy. Look here. Cases. If the company is an option buyer, if the company is an option seller, if the company is an option buyer, if the company is option sellers, if the company is an option buyer, the company has bought rights for purchasing or selling its own shares. Ignore this case because option buyer never bears loss in future. It will be anti-diluted situation, forget it. If the company is an option seller, then there are two cases. Either company sold call option or it sold put option. Then I explained you this by making examples. First and the second case, I have explained you all. Then I told the summary of call option. Call option summary. Company is option seller. If the market price is more, then he will exercise the option. The share which is expensive in market and cheap in the company, he will take that. Theory of concession rate begins, similar to free shares. If market price is less, why would someone buy shares at higher price when price is cheaper in the market? We will ignore it. Similarly, I explained you a question. From book 33, then I did 32. Later I explained put option. Then I gave you the summary of the put option. Put option summary. Examples are also given, notes are also written, summaries are given too. Look at this, what will we do with the option seller in the put option? If something in market is cheap and we can sell it at higher price, we can use option. What will we do first? Buy back into exercise price divided by market price. We will know the amount of issue required. New issue minus buyback, you get free shares now. You already know next step. While the second case can be ignored, this entire working, I made you write very important on question number 34. You wrote very important. Then I jumped to part number 7. The concept of 6th video is over. I explained you two cases. One is ESOP, while another is option. In the entire lecture, I only discussed two things. Then I came to 7th video. I am at adjustment number 4, share warrants. There is no difference in share warrants and ESOP. ESOPs are promised to employees while share warrant are promised to shareholders. If the company is not acting on new issue, then the company will issue share warrant. I had also told similar case in interclasses to some students. Company released new issue of 1 lakh shares. Company's issue is oversubscribed. People are waiting with money, but company can't issue shares. So the company tell them to give money. And they will give share warrants, meaning when company issues in future, they will convert their warrant into shares. People say what's the benefit for them? Company tell them that they will fulfill today's promise. In the future, when the company's grow market price will be there, they will not issue at that price but will lock current price. We are talking about concessional issue. It's all same here. Average market price, exercise price, the same free share formula. Is this clear? Whereas this also has the same ESOP issue. Every year at year end, right students? Till you have the warrants, you haven't created shares for it. Average market price basis free shares. The exercise price is the price that you promised, which cannot be changed. However, you will need to find free shares based on average market price. Average market price is different each year and free shares are also different. You have to follow same process ahead. Savings as 0 divided by shares overall, then adjusted it. This is same case that I did in ESOP. I have written somewhere. Let me see, I must have written the wording. Say this. calculation. All free shares will be same in ESOP, right? It's all similar. Example is done. Then I brought you to adjustment number 5. Therefore, students, this was our contingently issuable shares, which is very important. It was extremely important. In Ind AS 33, there are two situations given. There are two situations given in Ind AS 33. Case number 1, case number 2. When company to its employees, when the company promise its employees or shareholders to issue shares in the future. Okay, let's say the company told its employees, you help us by completing a target of this much sales, or help us reach the target of this much net profit, or make the company's market price reach here. The company has promised its employees that if you meet our conditions, we will issue shares to you in the future. Contingently issuable shares means that we have promised shares that based on some future event. It's called contingency. Two types of contingencies are given here. First contingency is if you have given someone a target. If you have any targets for your franchisees, agents, employees, shareholders, you have given someone a target and said, if you meet our target, we will issue you shares in the future. Second is, you have fixed a proper event, and if this event happens, let's say company has opened 5 outlets. So when the company opens its 6th outlet or company starts their business in a particular area, we will issue you shares. This becomes other than target contingencies. There are two types of contingencies, one based on targets and next is other contingencies. Your promises can be in two ways. Both the contingencies may lead to future share issuance, so it's considered in the diluted EPS. Then we explained it in different ways. The first case was, if the company has any contingency which is other than target, I have told my employees that if my company's expansion becomes so big, you get my showrooms opened in Kerala and Kochi. The day our company's first showroom opens in South India, I will give you this many shares. It's not a target contingency, but a contingency which is other than the target. Target is like sales, profit, market price, EPS. This is a special type of contingency. If I made any promises based on other contingencies, then you should be careful. Okay? Why? Because in this, we'll have to check the conditions. Pay attention. I'm going to revise the whole concept. If my contingency is other than the target, so I will have to check the conditions. Which condition? The condition is met or the condition is not met. Other than the target, the contingency I'm talking about, was the contingency fulfilled or not? Let's assume the contingency wasn't fulfilled. There's no contingency here. No, right? Then be it basic EPS or diluted EPS, do not use this anywhere. Take the name of your God and cut it. When I talk about other contingencies, first of all, check if the condition is met. Okay? If I said that showroom will open in Kochi, then I will give you the share. The showroom didn't open in Kochi, then condition will not be fulfilled. Then we won't use basic and diluted EPS. That's it. Second case, did the showroom in Kochi open? Yes, it's opened. Did the contingency meet? Yes, it's met. So now you check two things again. Are the shares issuable or are they issued? Showroom in Kerala is opened, contingency fulfilled. The condition is satisfied. Now you check that promise you made. Is that promise still valid or did you issue shares? If you have issued shares, So take it with the time factor in the basic EPS, the way you are taking the new issue, and ignore this in diluted EPS. But if the shares are issuable and you have satisfied the contingencies but haven't issued the shares, then you have to pay attention. So, in the basic EPS, take the shares according to the time factor, and in diluted EPS, take the shares in full. I want to take both. In the basic EPS, take it with time factor. In the diluted EPS, take it full. I explained you this in detail, and there was a contingency. Which contingency? Target 1. When you give someone a target with sale, profit, market price, EPS, then all these targets are checked against the balance sheet date. This contingency can be fulfilled any time of the year. When it can be fulfilled any time of the year, it can be linked to the basics. Contingencies related to target are checked with the balance sheet date. To see if the target for sales, profit, EPS, market price was achieved or not, it's checked with the balance sheet date. So, this can never come in the basic EPS, it can never come. Always it will come in diluted EPS. So, there are two cases here with conditions. Are the conditions met? Yes. Did conditions meet? No. So, just ignore it in the EPS, cut it off. If conditions are not met, what's the use of promise? When do you check this condition? On the balance sheet date. Yes, the condition is met. The condition is met. Take it to diluted EPS. That's it. Don't go to basic. Why will we see the target on balance sheet date? It's certain that shares will be issuable and not issued. As we'll check the target on balance sheet date, condition is met. We'll issue the shares. In current year, take it in diluted EPS. And point is, shares of other contingency, they come into places basic and diluted. We take it with time factor in basic and we take it whole in diluted, but these target ones, they are only with diluted. I have explained its working in these pages. Look, these are our contingencies. If contingently issuable shares are subject to target of turnover, profits, market price, this becomes our first case. If our contingently issuable shares are related to these other events, if these are other, it will come in both basic and diluted if conditions are met. And these will come only in diluted if the conditions are met. If the condition is not met, then ignore it. No adjustment will be made in the basic or diluted. Then I have also created its summary. Let me show you. Look, its summary. Contingently issuable shares, other contingency, conditions met. Conditions are not met. Ignore everywhere. Conditions met, issuable, issued. If it's issuable, then in basic EPS, take with time factor, and in diluted without time factor. If they are issued, then take it in basic. Let me correct it. Take in basic EPS. Basic is written in notes. There is an error in summary. Okay, then if our contingencies are targeted, then are they targeted? Then targets are seen on balance sheet date. 1 second. If they are targeted, they can be tested in year end only. Yes, are the condition met? So take it in diluted EPS. Conditions are not met. Ignore it. It was simple. Then I asked you to do some very good questions from study material. See, question from study material, the question number 29. Look, it is marked very important. I got message from a student on WhatsApp. You didn't teach this question from study material. He doesn't even know what are we doing. I got another message. What are students doing? They leave class material. Leave class books. Leaving such beautiful notes in class. They are referring other material. Refer to other material. I don't have a cure for that. I don't even reply to that query. Because students who doesn't value their own material, what can I tell them? I've been teaching for 22 years. See, my hair has turned grey. I color them. Are you understanding? what I am saying? There is nothing wrong in referring other materials. But is there something new? Things I discussed in class, students send same thing from different material. It's very sad, they don't know what they have read in class. Student who don't know their own material, what will he gain from other material? Are you understanding me? Your study material is completely covered with our notes. Your RTP, MTP are covered in the videos. Past examination are also covered. So this is your decision. I can't do anything about it. Question 29, best question of study material. Okay. Question number 30. Then I told you an exception. In contingently issuable shares, I had given you an exception, and that was passage of time. If you have promised to issue shares in the future, but that has condition of time, after 1 year this much, after 2 years this much, after 3 years this much. So where is contingency? Contingency is your uncertain event, but when according to the passage of time. We promise shares based on passage of time, but they won't be according to contingent shares. It's normal share, treat it same way, it will be issued, and then we will take it in EPS. Okay, so after that we have done question number 25. 25. So after that other various concepts has begun. The first point in it was participating preference share. Okay, participating preference shares, what are they? Which have a stake in our retained earnings. The company earned net profit. Out of this, preference dividend was paid and equity dividend was paid. This is company's retained profit. Its share is called undistributed profit. Even in this, preference share capital gets share and equity holders get the rest. So if a company has participating preference shares, in that case, when you will be calculating the EPS, then you will be needing the equity shareholders, distributed profit, and their undistributed profit. We need to club these two. So you have to remove the dividend of the participating preference share. You also have to remove the undistributed profit for the participating preference shares. These types of shares are irredeemable by nature, because if they were redeemable, then in AS 109 will treat them as financial liability and find interest. They don't get share in profit. In India, redeemable preference shares are not in culture. It is not allowed in section 55. It's a foreign concept. It's just copy pasted without thinking. It's very important for practical questions but zero value in life. What you need to do, create a chart first, net profit, then fixed dividend, then stake of equity holders, then whatever is left, it's undistributed profit. Calculate it in proportion for preference and equity shares. Okay, now from this share of equity and from this share of equity, on this basis, you can calculate the EPS. From earnings available for equity shareholders, we will find its EPS from its distributed and undistributed portions. Remove the preference distribution and preference undistribution. Okay? See, it's a simple formula. Basic EPS will be computed on the basis of shares of equity holders in distributed plus undistributed earnings. So this is one part here, and here's its other part. We will club these two. We will divide it by weighted average number of shares to get its EPS. We have discussed it in class. Then we had done question number 27 from study material. Allocation of fund distribution will be done. Then we will find EPS. Question number 27, it's a good question. Then we did 28. One more question. It's all from study material. Then I took you to another point in various concepts. And that was consolidated financial statement, CFS. CFS is holding plus subsidiary. Everyone has read consolidation? I have also shared the revision classes on consolidation. What you have to do? when we find EPS for CFS, so first is holding companies, profit, then add share in post acquisition profits. So here we have to add holding company's share in profit post acquiring the subsidiary company. Whatever profit subsidiary has will go in holding and the NCI. It's done. Holding has two profits, one in pre and other in post. Pre will go in calculation of goodwill on acquisition date, and post comes in same heading and gets added. So we divide it with weighted average number of shares of holding company. So when we calculate the EPS in CFS, it's a very simple concept. You add the holdings on EAE to the subsidiary company's post acquisition profit. Then we will find its average and use it. First is holdings own EAE, and next is its share in his post acquisition profit divided by own share. After explaining this much, students sent doubts on WhatsApp. You have not included subsidiary shares, you are only adding the profit. Because in consolidation we learn holding company I mean subsidiary company's shares capital, and pre-acquisition profit of subsidiary company gets cancelled. What do we do in 103? In 103 we are asked to enter the debt of acquisition, assets to liabilities to NCI to cash, and put the difference in goodwill. On date of acquisition, these assets and liabilities are equal to the capital plus reserves. So when you took these assets and liabilities, it cancelled itself. Okay? Is subsidiary company's capital left? How will you add it? It's very sad. Because when this concept was taught in class, I explained the whole story. You know, I don't take shortcuts. Whenever we discuss something in class, didn't you see the presentation of notes? Proper headings are made concept by concept. Proper presentation has been made for everything. All these has been taught in class. You have notes, you have videos, you can match them. Okay, then after that, we will keep moving forward just like this. Keep going, keep going. All these questions have been done. All are consolidation questions. These examples are done. Question number 36 is done. Question 37 is also done. See, it's in front of you. After this concept number 3, this was breakup of EPS. What did I say in breakup of EPS? Company's EPS needs to be shown in 3 headings. EPS from continuing operations, EPS from discontinued operations, and then the third was overall EPS. Company's EPS goes in 3 headings. And then I added special point in this when we recorded new questions video. I will tell you. In that I had told you to write a point on diluted EPS. Now assume these are continuing operations. And here it's diluted EPS. Yes, what is this diluted EPS, right? But when you added the discontinued operations in this, so this is anti-dilutive. Because impact of discontinued is anti-dilutive, so here in AS33 said that first you should check what are the results of continuing. We said continuing is showing diluted, but discontinued is showing anti-dilutive, and because of this overall is anti-dilutive. Ind AS 33 says you give disclosure of overall anti-dilutive. So show it's diluted, show it's anti-diluted, and show overall anti-diluted because continuing is diluted. I told you another case. It's anti-dilutive, it's dilutive, and because of this overall is also dilutive. I said we don't have to disclose this because what we are continuing is anti-dilutive, and I said one thing in end. So overall EPS, I mean diluted EPS, will be based on continuing. If continuing is dilutive and discontinuing's impact makes it anti-dilutive, it doesn't matter. Its disclosure will be the anti-dilutive. Okay? If your continuing which is anti-dilutive gets impacted and becomes dilutive, it won't be disclosed because report of diluted EPS will be based on continuing. I told you all about this. Just wait, I'll show you. I will be back on this, then on this too. This is the only thing I told you in part 8. Explanation of disclosure of dilutive EPS if entity has discontinued operations. C. If continuing operations have positive results, then disclosure of dilutive EPS will be made, even if it is anti-dilutive due to the effect of discontinued operations. It can be said that, read here, see its crux. It can be said that disclosure of overall diluted EPS will be made. If EPS is dilutive in case of continuing operations, comments disclosure of overall EPS will depend if continuing operations are showing dilutive results, its controlling factor. Continuing operation is controlling factor. If EPS for continuing operations become anti-dilutive, it's controlling factor. If continuing is anti-dilutive, we will not disclose it. Even if it is dilutive due to effect of discontinued operations. This point was very important. Okay, after explaining all this, these 2 points were left. Suppose it's loss-making company. Which company? Loss-making company. So basic EPS of loss-making company will be visible in brackets. And let's say the company has ESOPs. They have ESOPs, you know very well that EAE, which is negative, we will add 0 to it, okay? Weighted average is number of shares, then we will add free shares to it. After this, bracket will be reduced. It's a sure thing. People who will share loss have increased. If people who are sharing profit increase, then it's dilutive. But if people sharing loss will increase, then loss per share will reduce. And this creates an anti-dilutive case. Its disclosure is not required for you. If your profit per share is falling, that's dilutive. If loss per share is falling, that's anti-dilutive. In loss-making companies, if you see loss per share going down, it becomes an anti-dilutive case. If loss per share becomes less than basic loss per share, after adjusting potential shares, it will be considered as anti-dilutive and disclosure will not be made. And now last point, and that last point was, the company doesn't have any potential shares, neither ESOPs, nor convertible preference shares, nor convertible debentures, nor share warrants, nor contingently issuable shares. Company does not even have warrants, nothing. Company has 0 potential shares. Then company's basic and diluted will be same. And when the company's basic and diluted will be same, then company's reporting will go in single line. What will the listed company write? Basic EPS and diluted EPS 2 rupees. It will tell you there are 2 basics and 2 diluted, there is no reduction. But you can't report like that. Your basic EPS is 2 and you wrote nil in front of diluted EPS, right? We can't show this because this nil word goes in favor of company. That company's EPS will not fall but increase. No, disclosure should be done this way. Means basic and diluted is 2 rupees. This indicates that company does not have any potential share. This is favorable disclosure. I explained this point. Student sent me screenshot of listed companies EPS annexure. Sir, this is reported into lines. You said it would be in single line. Let me tell you, there is something called professional integrity. A CA doesn't have the right to doubt on another CA's knowledge, okay? In professional integrity, we don't challenge like this in open market. Even report have many mistakes. Sometimes when CA receive audits of listed companies, they take 3 to 4 years to learn about it. What's in the market? These big 4 like PwC. What people do, they pick their audited specimen and start creating reports on that basis. But after 3-4 years, they understand that they can't work this way, it's different. So if you don't see any report as per Ind AS, don't make notes on it. In professional integrity, our lobby of CAs is like this. We don't doubt on others. We should not write anything about anyone because it will hit us later on when one CA challenges another CA. Have you seen doctor challenging other doctor's prescription? You are getting treatment from doctor but not relieved. you will go to another doctor. He will not listen if you badmouth him. He will say, leave it. Because they know it's not in the interest of the profession. Don't look at such things. Okay, this is the complete revision of the Ind AS 33. Thank you very much. Take care. Bye bye. Love you all. I will bring new Ind AS in next video. Bye bye. God bless you. Love you all. Bye.